Mr. Q has determined the valuation of Rhythm Limited. Valuation of Rhythm Limited to approach. One is a market approach, second is an income approach. Select the highest of the final value, but the management of the Rhythm does not satisfy the request. You will determine the fair value of the shares of Rhythm Limited and assign the weight of the market approach or income approach ratio 4 is to 3. 4 is to 3 ratio, you need to determine the ratio. Determine the equity value based on the following: valuation of the market of 45 lakhs 82 380, valuation as per income is 21 99 930, debt obligation of measurement 996 812, surplus cash and cash equivalent. This is the cash asset, fair value of surplus and assets. This is an equity. Number of shares is 1 lakh 3000, valuation market income approach. Answer: equity of the valuation term weight 3 as per the market approach 3, income approach through as per my 75 lakhs 21 lakhs, the estimate 70 percentage and 30 percentage 31 lakhs 69,000, less debt of the organization 9 lakhs, add surplus of cash to 1 lakhs, add the fair value asset 3.1, so 26 lakhs, number of shares, and so equal to 2.015. Simple. PQR Limited has acquired a building for its administrative purpose and presented the same as a property, plant and equipment on the financial year 2019. During this financial year 2009, it's located the office to a new building and release the said building and lease the same building to third party. Following the change in the usage of the building, PQR Limited reclassify the PPE to investment property in financial year 1920, and should PQR Limited account for the changes in the change in accounting policy. Should PQR Limited account for a change in accounting policy. So what they acquire a building that used for administration. They have another building, they set it for lease. What is the difference? So the asset has been bought in. So fixed asset plan, property, plant, equipment, it has increased. Correct. Second point, the usage of building doesn't, or I should, that's not even a problem. So leasing the building is something, operation lease or financial lease. So one thing, you leasing the property, you get a same, you're going to charge depreciation on the property, it's not going to change. You're going to have another set of income, that is a rental income or lease income, or you get a fixed amount as a lease and put in FD. So what is going to be changed? As per India AS 8 provide application of accounting policy for the transaction. Other events and conditions are different and some husbands for this previous occurrence or non changes in accounting policy. India 16 plant property and equipment is a tangible asset that is that's held for the use in production or supply of goods and service for the rental or other administration purpose. They expected to be used and used during the more than one period. As per the NDA's 41, investment property, land and building, or the part of the building, or both. The owner of the lease has a right. The owner of the lease has a right of the. As per in AS 40, investment property is a property, a land of building or a part of the building are both held by the owner or by the lessee as a right of the use of property or to earn rental or capital appreciation or both, rather than use of an production use in the production of supply or use in the production or supply of goods and service on administration purposes, sale in ordinary course of business. As per the above definition, whether the principal building is an item of a property, plant and equipment, or investment property, or the entity depends upon the purpose of which is held for equity. As a possible is that due to the change in the purpose of this, which is held, the building as a previously classified as an item of property, land and equipment may warrant classification as investment property, and vice versa. When the building is a nature of plant property equipment, investment property is determined by applying the definition of the items for the Purpose you of the entity. There's a classification of the building as an in term of property, plant and equipment as an investment property or a matter of the accounting policy choice. Accordingly, the change in the classification of building from property, plant and equipment to investment property due to change in the purpose, which is held as the entity, is not a change in accounting policy. Sherwin Limited was 6,800 ordinary shares of PQR Limited, an unquoted company. That is mean it has not been listed. The PQR Limited has a total share of 2 lakhs shares and nominal value of 10. The PQR Limited after the tax maintainable profits are estimated 28 lakhs per year. An approach of price earning ratio determine the published industry data is 12. Before lack of marketable adjustment, Sherwin Limited management estimate that the discount of the lack of materiality of PQR Limited shares restrict the transfer is 18%. Okay. Sherwin Limited shares holds by PQR Limited share based on its earning. Determine the value of Sherwin Limited's investment PQR. So earning based valuation. Sherwin Limited holds a share company PQR. The SQPQR after tax maintained profit 28 lakhs. Earning ratio 12. Adjustment discount rate is 1 is to 18 percentage. So 0.82. So 0.82 so 28 into 12 into 0.82 is 2 crore 72 lakh 16,000. 20,000. The fair value of Sherwin's investment in the estimate is divided by 6,800 shares. Okay. Number of shares in BQR 2 crores 50,000. Total of shares is 170, 137. Value of Sherwin's investment in PQR Limited is 137 into 6,800 is 938. So what they do? So 0.2 into 12%, 18 percentage not into 12 into 1 minus 1.18. Bottom now you will get one value that divided by number of shares. That divided by number of shares, you will get the value of each share. You multiply with share and share, one shares, you get the value. Silver Limited. Silver Limited in the process of acquiring shares of Blue Limited. In the part of business reorganization plan, the projected free cash flow of Blue Limited next 5 years. Cash flow year 1, cash flow year 2, cash flow year 3, cash flow year 4, cash flow year 5. Okay. 220 crores, 280 crores, 290, 192, 140, and totally 5,900 crores terminal value. The weighted average cost of capital is 10%. In total debt measure is 2195 crores and the surplus cash and cash equivalent to 195 crores. Total number of shares in measured as 12.8 crores. You are required to determine the value of the share of Blue Limited as per income tax 1153. The present value factor is of 1 rupee will be takes to 4 decimal for the purpose of calculation. Okay. Oh my God. The cat discounted 1%, 10% 0.9912 year. Terminal value 280 into this, 281 into this, 181 this, 430 into this, and 551 plus 500 into this. Then we get a total of all years is this. And you are subtracting what measurement total depth in the measurement 2195. You are subtracting 21 measure rate and and add back the cash on the percentage, you will get the total equity of the number of shares 12 crore shares and the equity value per share you get 224.82. All is in crores. The financial statement of the company of the 31st or 21 and approved by the management on 5th June for the review approval of the supervisor officer for the board of director. Supervisor board approved the financial statement on 26th June. The financial statements are then made available to the shareholders on 4th July. So 20th June approved, 4th July applied. The financial statements are approved by the shareholder on the annual general meeting on 18th August. Then filed with the Minister of Corporate IMC on 19th August. Determined and discussed the date in which financial statements were approved. First date, financial statement should be prepared. When they prepare and when preparing, it should be first approved by the board of director, that is management, on 5th June. Then after, auditor would review it and give one report. Auditor report will be given. After the audit report, the supervisor board approved the financial 26th June 2022. Financial was approved by the management of June and the supervisory board of directors. Supervised board approved it on 26th June. The financial statement are then made available to shareholder. And in the AGM, it was totally approved in 19th August and filed with the MCA. Actual date of this is 5th June itself, it is approved. As by NDA and the companies, the financial statements have been treated and approved by the board and managing managers approved the same. Thus, the given case, the financial statements are approved on 26th June. The data approved of board of directors and issue the financial statement to shareholders. Oh, 26th June. Supervisor board is approved. Is approved. Okay. Company with a company is a litigation with the income tax department respect of the allowability of certain exemption in the financial statement for 2018-19. No provision of no provision of tax has been made for disallowance. No provision of tax has been made for the disallowance of the exemption, as the company under the bona fide believe that based on the legal opinion it will succeed its litigation. On 21st April, the Honorable Court rejects the company's claim. In order to revise on 30th April, the financial statement of the financial statement of the financial year 2023 for the company is yet to be approved. The earlier year financial statement stands approved. The objective of the financial statement is how financial year is impact the order and Honorable Supreme Court should be recognized. So, as per the accounting standard, contingent liability should be considered. But they said they can win the litigation. But fortunately, the events that occur after the after signing the after creating financial statements, events that have takes place after the preparation of financial statement, that should be considered. In this case, in that taking that into consideration, we say that this amount to be added is correct and it should be added. Financial statement which will actually impact the order of, yes, it will affect, because on 31st March we say it's not a great issue, but when the event happened, it gives the circumstances that the event whatever happened should be recognized in the books of account. There is no way of saying that I can't accept that issue, right? An event after reporting period is adjusted event if it is provide evidence to the condition that exists at the end of the reporting period. The court order received after the reporting period but before the financial statements are uploaded. Providing evidence and liability exists at the end of the reporting period. Therefore, the event will be considered as adjusting event, and however, the amount will be adjusted in the financial statement for the financial year 2023. Is it limited as prepared and financial statement on 31st March makes a provision for doubtful debt 6% and accounts receivable. The last year, 2023, a debtor of 3 lakhs has suffered a heavy loss in fire and was not recovered any insurance policy. Is it limited to consider the event of the fire made provision 60% the amount receivable from its debtor. Apart from that, provision 6% remaining debtors. The same debtors is declared insolvent 10th April. The financial statement had not yet approved. You are required to suggest whether the company would provide a useful full loss arising from the insolvency of the debtor and the financial statement from the end of 31st March. What to do? So in this case, they on the 31st March they have a debtor who's has a heavy loss, and they have booked their receivable 60 percentage bad debts. But this event has been recognized. But before signing the audit report, after signing the audit report, he's completely insolvent. Now it is the event that occurring after the balance sheet date. So such event is adjusting event. So what happens? The total amount of the part the debtor to be considered totally bad debt. Bad debt. So in the instant case, the fire took place in January 23. It is before the end of financial year. Therefore, so we should say the event which occurs before the financial year, or the knowledge of happening is there before signing the audit report, before preparing the financials. Signing the audit report is there, the knowledge is there. That's the first thing. That's a good question you should need to ask. Therefore, the condition exists on the end of the reporting date, which is debtor is declared insolvent after the reporting period. Accordingly, the full portion of the bad debts amounting to 3 lakhs should be made to cover the loss arising due to the bankruptcy of the debtors and the financial statement of the end year of 31st March. Okay. D Limited acquire an equity shares of another company 31st March on a cost of 28 lakhs. The fair market value of the shares of 31st March is 35 lakhs. So increased. And the company measured at 35 lakhs, assuming it is classified in FVTOC as per NDAs 109, and change in fair value transfer to fair value fluctuation reserve. Due to the market conditions on subsequent to the reporting date, the value of investment drastically came down to 20 lakhs. The financial statement have not yet approved, but you are required to suggest the deal limited should have value in 35 lakhs or 20 lakhs on 31st March. As per the NDAs, the asset should be valued if it is a listed company. What is the value of the share should be recognized, and that value should be considered on the end of 31st March. Okay. So, and drastically falling down after the period, after the audit signed report, such thing we can't do anything. Decline in fair value of the investment between the end of the reporting period and end of the financial statement approved from the for issue of non-adjusting event. The declare of fair value does not normally related to condition of investment at the end of the reporting period, but reflect the circumstances that have arisen subsequently. Therefore, D Limited should value the investment 35 lakhs and 31st March. Yeah, 35 lakhs, that's correct. Tanmay Limited was in the negotiation with the Varun Limited on 1st December 23 to acquire the land for 5 crores. The negotiation was concluded in the first week of April, and the transaction was completed in the last week of April. In this financial year, the purchase of land should be recognized. So, only the transaction should be recognized, and it can be adjusting event when an agreement is there and there is a legal binding that states so the risk is transferred, the risk of the property, the risk and reward of this being transferred. There is a prior agreement that we will do that. Any sort of proof should be there to take such kind of action. On 31st March, the property is in name of the Tanmi Limited, and they have not transferred the property to Varun Limited. So on 31st March, there is, if there is any agreement stating so, this April this land will be purchased. This amount is received as advanced for this selling of this land in 10 Limited. Such kind of evidence, if that is available, you can disclosure procedure. You can say the asset has been ready for sale. It is going to be sale, and our being can say sold. If not, it is not an adjusting event. As per Ind AS 10, an entity should adjust the financial statement for the events that are occurring after the reporting period but before the financial statement approved for the usage. If the events provide evidence of condition that exists in the end of the reporting period, in this case, a negotiation was Varun Limited for acquire the land from 31st December to 1st April, since the reporting date conditions of only the proposal date. Transaction was completed in first week of April and the event will be considered as a non-adjusting event on that NDA's 10. A purchase of land should be recognized in the financial year 2024. However, the same may be disclosed in the notes of account due to the information used of the financial statement. The HG Incremental Limited has passed made a right issue. It is offered documents to its member has projected surplus of 50 crores during the financial year and 31st March 23 ending. The DAF result from the year ended 31st March and prepared on the hitherto followed accounting policies and presented the visual of the board of directors showing surplus of 5 crores. Uh, Projected surplus 50 crores and actual surplus 5 crores. The board is in consultation with the IMD deciding on the following. The value of the year-end inventory cost for 40 crores instead of Hertho method. This valuation inventory prime cost 20 crores. Not to provide after sale expenses during the warranty period till the last date. Provision 1% of total could be made under concept of matching the cost against revenue and actual cost has been charged against a provision. The board would decide to account for the expenses as they when actually they incurred. The provision of depreciation for the year is straight line method and the only subsequent addition in gross block during the year instead of the reducing balance method, which is here to adopted as the consequence of 25 crore depreciation is now less charge that has been provided under the old method. That is 47, 67 crores reduced balance method to 46 crores straight line method. Providing for the other temporary fall in the value of investment which takes place in 6 years amounting to 12 crores. Discuss the above situation as per the applicable application of NDAs yearly NDAs 18 whether the above change in accounting policy change in estimate. So I've seen that first on the value of inventory cost 40 crores instead of value of inventory prime cost 20 crores. As per the valuation of inventory, the cost or fair value, whichever is less should be cost. The inventory has included work cost, that is mean work in progress cost is also added there, but the prime cost only added. So the inventory that includes work cost should be added. Not to provide after sale expenses during the warranty period till the last year version of 1% sale used to make under the concept of matching the cost against revenue. The actual expenses used for charge against provision. The board may decide as to account for expenses as and when actually they incurred Sunday when incurred during and during a sale. 800 crores like 8 crores is after sale cost for the warranty period. Do they need to incur? Yes, they need to incur because there is a warranty period. So they can say, so this year we had a warranty period, and what is the actual expense incurred may be different, but provision for 8 crores to be kept there. So as per the accrual concept, we need to keep book the 8 crore expenses. Providing depreciation for the year straight line method accounting substantial addition to the block in year and instead of reducing balance which is here to adopted as per the concept 21 crore depreciation. So there is a change in the policy straight line method to reducing balance method. Is it possible? Yeah, they can do. They need to they if they did something like this, they should give in the mention of account. Is that been mandatory to give? The reason for why the straight line is being converted into reducing balance method should be given in the notes to account and they should define it and that should be relevant. It should not be relevant in case to increase the profit. provided other temporary fall in the value of investment which fall took place last 6 years amounting to 6 crores. So the investments are valued at their fair value. That is also good. Paragraph 36 1A inventory specifically required disclosure of cost formula used in the disclosure of the accounting policy adopted in the measuring of the inventories. Accordingly, change in the account cost formula is a change in the accounting policy. The entity should apply the change in the accounting policy retrospectively. For retrospectively applicable, the change in the accounting policy adjust the opening balances of the each affected component for the earlier period and prior presented and other comprehensive amount disclosed for each prior period presented and if the new accounting policy has been applied. Usually, the adjustment is made to retained earning. The income tax effect due to change in accounting policy will be accounted in accordance with the India as well. Because we can change in such kind of concepts that will to prior period also that will affect the income tax also. Here, since the question talks about making provision, it is assumed that assurance warranty has been provided by the entity. Further, provision of 1% is against after sale expenses and accounting policy discussion. Now, since the company has decided not to make the provision of such expenses but the account of the same as and when expenses incur, this change of accounting policy decision. A change in accounting policy accounted for retrospectively. A retrospectively application of change in accounting policy adjusts the opening balance of the affected component of the earliest period and the period presented and the other comprehensive amount disclosed to the either prior period represent as if the new accounting policy has been applied. Usually, adjustment is made in the returned earning income tax effect due to change in accounting policy will be accounted in accordance with the Ind AS 12. Determination of a depreciation method involved in accounting estimate. That a depreciation method is not a matter of accounting policy. As per India 16, a change in depreciation method should be accounted as per the change in accounting estimate in accordance with the India 8. The change in accounting estimates accounted prospectively. However, the effect of change in recognized income and expense of the year in which change is made. The effect of any of the future period recognized as a income and expenses for the future period. Accounting of investment made in the entity falls under the preview of Ind AS 109 financial instruments. As per the Ind AS 109, subsequent measure of financial instruments done in the following basis: measurement of amortized cost, a measurement of fair value through comprehensive income, measurement of fair value to profit and loss account. In the consequently measured financial asset that the investment is FVTOCL, FVTPL, the change of fair value should be recorded earlier in the previous year period and such case. This is no change of accounting policy or accounting estimate. However, the entity had not accounted for the previous changes in the books. Then the error, if the error is material error occurred before the earliest period, prior period is presented, the entity shall, unless impracticable, correct the same retrospectively in the first set of financial statement, upload the issue after the discovery of restating the opening balance of the asset, liability and equity of the earliest prior period presented. Further, the fair value of the changes to account of every reporting date. Hence, the restatement of the comprehensive amount of the prior period presented in which error occurred has been required to be done. Further, the entity reclassified any financial asset it must be prospectively to reclassify them. The entity is not restate any of the previous recognized gain or loss of the impairment gains on. Further, the entity reclassify any of the financial asset. Yes, it must do prospectively. For the entity reclassify any of the financial asset, it must do prospectively for the reclassify it. So from this period, not the prior period, retrospectively, entity shall not restate any of the previous recognized gains or restate a previous recognized loss, including impairment gain or impairment loss in interest. The reclassification of financial asset will be accounted for the accordance with the guidance note of Ind AS 109. Ind AS 115 revenue for contract with consumers. Transaction India is 115. The effective of annual reporting period beginning on or after 1st April 2018. Entities are required to apply a new revenue standard using either of the following two approach: full retrospective approach or modified retrospective approach. Full retrospective approach in each prior period presented in accordance with NDAC, subject to some practical expedited method mentioned in the standards of modified retrospective approach. Retrospective will be cumulative effect of initial applicable recognized at the date of initial applicable. When a full retrospective method, the entity shall restate all the prior period presented in accordance with NDAs 108. In result of the comprehensive statement, all the period presented in NDAs 115 shall be affected since the beginning of the earliest period presented. When the applicable modified retrospective effect on the entity does not restate the prior period presented and the cumulative effect of the initial application is recognized in the opening and return earning of the first year is applicable to NDAs 115. மற்றது பண்ணாமல் சில காலங்கள் மட்டும் ஃபஸ்ட் இயரில் மட்டும் பண்ணிட்டு போகுது. Orange Limited contract the renewal of the five-star hotel including the installation of new elevators on 1st April 2017. Orange Limited estimate the transaction price will be 480 lakhs. The expected cost of elevators 144 lakhs and expected cost of elevators 144 lakhs. Expected other costs is 240 lakhs. Orange Limited purchase the elevator and then deliver to site 6 months before they will be installed. And Orange Limited uses the input method based on the cost of measure progress towards completion. Entity has incurred actual other costs at 48 lakhs. The entity has incurred actual other costs 48 lakhs on 31st March. How much revenue will be recognized as per the relevant to NDAs for the year 31st March if performance obligation is met over a period of time? ஒரு லிஃப்ட் இன்ஸ்டால் பண்ணுறதுக்கு they cost 480 lakhs, but the cost is 144 of the machine and other fixing is 240 lakhs. So it's deliver before install it's deliver 6 months. So the asset is came into use but not put into use. So even though the asset is came, they claim the input. Okay, I incurred actual cost, other cost of 48 lakhs they incurred for the putting something. How you do? Do you consider as a fixed asset or do you book as a expenses? It's a question. Cost be incurred comprise of two major component of elevator and cost of construction services. Elevator is elevator is part of a overall construction project and are not distinct performance obligation. The cost of elevator is substantial to the overall project and incurred well in advance. Upon the delivery of this site, the customer acquire the control over the elevator and this is modified done by the elevator, which is a company only procedures and deliver at rate sites. Upon delivery site, consumer acquire the control over the elevator. There is no modification done by the elevators, which a company only procures and deliver at site. Nevertheless, apart from the material use or overall construction project, company is a principal in the transaction with the customer for the such elevator also. Okay. Therefore, applying the guidance of the input method, the measure of progress should be made based on the percentage of cost incurred related to the total budgeted cost. The cost of elevator should be excluded when measuring such progress, and revenue of such elevator should be recognized in the extent of cost incurred. So the revenue recognized is transaction cost 480 lakhs, cost of elevator 144, other cost 44. So 48 into 480, that is what total cost incurred is 20%. Revenue to be recognized. And the cost incurred total attribute revenue 336% of the work completed 20%. Revenue to be recognized 67 crores. Revenue for elevator 144 equal to the cost 144 plus 67 is 210. Therefore, in the year entered 31st March, company shall recognize a revenue of 211.2 lakhs as a project cost. Nivan Limited commenced the work of two long-term contracts during the financial 31st March. The first contracts of A Limited commenced on 1st June and the total sale value is 40 lakhs. It was Again, we say that contract should run for 2 years and the total expected cost should be 32 lakhs. On 31st March, the Define Limited revised the estimated total expected cost to 34 lakhs. So 30 to 40 lakhs to 32, say 32 to 34 lakhs cost. And the basis of the addition, rectification cost is 2 lakhs to be incurred on the contract during the current financial 34 to 36 lakhs. Independent survey has estimated on 31st March contract is 30% completed. And even limited has incurred cost up to 31st March 16 lakhs and has received a payment on the account 13 lakhs they have received. They have billed 16 lakhs and they have cost 30 lakhs. How much they should consider as revenue? A second contract BN Limited commenced on 1st September and for 18 months, a total sale value of the contract is 30 lakhs and the total cost expert 24 lakh. The payment of the account already received for 9.5 lakh and total cost incurred the date is 8 lakhs. Remain limited as in insist on large deposit of B limited. However, the company has traded together the period of the contract. Independent server estimate 31st March a contract is 20% complete. Two contracts meet the requirement of India's revenue. India's 115 revenue from the contract with consumers to recognize revenue over time as the performance obligation satisfied over time. Company also company also have several other contracts between 12 and 18 months in duration. Some of these contracts fall into two accounting periods where are completed 31st March. In absence of any financial data relevant to other contracts, you are advised to ignore these contracts while preparing the financial statements on 31st March. Prepare a financial statement, can extract the Nivan Limited respective two instructions. Like contracts over 31st March. So total cost. So what is the expected revenue? 30 lakhs a bill what about? But we have expected profit is 6 lakhs. That has been then the cost has been increased to 34, 36, 38. Then the revenue to be recorded is 2 lakhs as a profit. At the same time, another contract that is a cost that's being incurred. So there is a different things. Now what we have to do is how much is completed. What is the payment? Payment received. Payment received can be completed. What is the project cost? On the project total cost, you need to book the profit. So 30% of 30 lakhs, 30% of 31. This is what you should do. The current asset capital work in progress is 9 crores, capital liability is 4.5. How extract a statement of profit and loss is on there. So revenue from contract, cost of revenue, net profit. Table showing the total revenue. So total cost 40, total cost 30, 20% completed, 20% completed, 6, 6, 12. Expenses during the year 34 30%, 1.5, 24 20%, 4.5. So 1.8% profit, 1.2% total 3 crores. So இங்கே வந்து revenue 18 crores, expense 15 crores, 3 crores. That's it. So then what? Contract asset 9 crores. How? Additional rectification cost 2 lakhs being treated as a normal cost. Hence, the total expected cost becomes as 34 lakhs. However, the case of 2 lakhs is treated as an abnormal cost and then expenses during the year 11.9, 11 lakhs, 30.32 lakhs is 2 plus. According to this expected as AO Limited, A and Co. The profit of the year is 0.4 lakhs and work in progress recognized in the year is 4.4 lakhs. Computation amount to calculation amount due to customer. Billing on the basis of revenue 12/6/18 now, but received 13/9/22. So 1% asset advance, 3%, 3.5 advance, total 4.5 advance. Work in progress. Actual cost incurred is 16/8/24. Less recognized in the books on the 10/4/15. Work in progress recognized at the end of the year. Cost recognized is 5.4 5.8 3.29. This way should do from this total contract cost liability contract liability 4.5. Extent of profit on last statement. Revenue from contract 18, cost of revenue 18.9, net profit is 1.6. Super. Construction contract we should be working in that way now. That's what they say. It is A7, A18. ABC Limited supplies plastic buckets for the wholesale customer consumers. As per the contract entered into ABC Limited and the consumer of the financial year 1920, the price of plastic bucket will be decreased retrospectively for the sale as the sale value increases within stipulated time. The price applicable for entire sale is based on the volume of bracket. So 90 for 1 to 10,000, 80 for 10,000, 1 to 35,000, and 70 for 35,001. All the suggestions were under the made in all transactions made in cash. Suggestion how the revenue will be recognized in the books of accounts of ABC Limited as per the expected value method. Consider the probability of 15, 75% and 10% of sale volume of 90,000, 28,000 and 36,000. For working the let assume that ABC Limited achieve the same number of unit of sales if they are to the consumers based on during the year and initially estimated under the expected value method for the financial year 1920. In the case of ABC Limited decide to measure the revenue based on the most likely method instead of expected value method. How will be the revenue recognized in the books of account on 31st revenue books of accounts of ABC Limited based on the above available information? For working, assume that ABC Limited achieved the same number of units of sales to the consumer during the year as an initial estimate under most likely to be value method for the financial 1920. You are required to pass journal entries in the books of ABC Limited if the revenue is accounted as per the expected value method financial 1920. Determination of value based on the recognition of books of account ABC Limited as per the expected value method. Sale volume probability. So sale volume into probability. Probability wise this units. Unit into sale price and probability. 9,090 probability. So then probability of weight of sales, probability value of sale units. So 79.13 per unit can be sold. Revenue recognition 79.13 of a unit sold. First 10,000 units be sold booked in 90 per unit. And liability incurred for the difference of 10.3 will be reversed upon subsequent sales of 1593. As a request states ABC Limited achieve the same number of units of sales the consumer during the year initially estimate under the expected value method for the financial 1920. For subsequent sale of 15,950 units, the contract liability incurred 0.08, 80.79 units profit will be deferred. This income will be deferred. Determination how the revenue will be recognized in the books of account of ABC most likely method. Assume though the sale volume is 28,000 unit and given under the expected value method, the highest probability of sale estimate is most likely method. 28,000 to 80 is 22 lakh 40,000. Average price is 80. The first 10,000 units be sold in 90 and the liability of 1 lakh will be accrued deferred or the price of 10 unit 90 units will be reversed upon subsequent sales of 18,000 unit. And the question of ABC analysis achieved the same number of units of the sale to the consumer during the year is initially estimated under the most likely method of financial year 1920. Alternatively, the question may be resolved based on 25,950 units calculated on the expectation value method. Manage the target. So 25,950 is 80 per unit. So 20,000. 20 lakhs 76,000. Average cost per unit is 10. First 10,000 units be sold in 90 and the liability accrued and the difference of 10 will be reversed upon subsequent sale of 15,950. This is journal entries for every. So bank 10,000 into 9 lakhs. To revenue account at 73 7 lakh 91 liability and the revenue recognition the sales of first account. Bank account then received 11 lakh 80,000. The revenue actual revenue is 12 lakh 90,000. Liability is accrued with 86,000. This will be adjusted in the excess paid in the earlier and the customer will fall no second lag. Liability to revenue account is 22,002. On the reversal of liability to the end of the financial year after the completion of stipulated time. Alternative in the place of first two entries, one consolidated entry. Bank account 20 lakhs to revenue account 20 lakh 53,000, liability 20,000. In second journal entry, assume that the consumer has paid the amount of 11 lakh, adjusted was excess 1 lakh paid with the first lot of 10,000. However, one same journal entry will be total as sale value of 12 lakh 76,000. Later on the past, the third entry is refund. In this case, 2 and 3 entries will be followed. Bank 80, revenue is 79, liability 13,000. And liability to revenue account to bank 1 lakh. Reversal of liability in the last year. After completion of stipulated time and excess amount refund.